Let's go through insurance terminologies so that we can understand the domain better. Premium, pretty easy. Amount paid by the policyholder to the insurance company. Example, so for a term plan, if we have paid 15,000 per year, then 15,000 would be our premium. Sum assured, the guaranteed amount paid by the insurer if the unfortunate event occurs. Example, let's suppose we have a term plan of 1 crore sum assured, and and if the policyholder dies, then the nominee will get 1 crore amount. Nominee, the person who receives the insurance money after the policyholder's death. Rider, additional benefit added to the base policy for extra protection by paying extra premium. So let's take an example. We have bought a term plan. If we add critical illness in that, we'll get the sum assured even if we fall ill due to critical illness. Okay, so if the base policy is 50 lakhs, accidental rider is 20 lakhs, then the total payout in accident would be 70 lakhs. Underwriting. It is a process of evaluating risk before approving a policy. So underwriter basically evaluate the risk and validates whether the policy should be given to the policyholder or not, so that it will benefit the insurance company. So underwriter would check age, health condition, income, lifestyle habits such as smoking, drinking, or any other. Right? Example, a smoker may be charged higher premium than a non-smoker. Actuary or actuarial science. So actuaries are the experts who calculate risk and decide premium pricing using statistics and probability. So they decides the premium pricing for term plan for health insurance based on various factors. So factors are mortality tables, risk models, historical data. So they will go through the historical data and then they might predict the today's premium pricing. And they will see the mortality tables, which means that how many people are dead of a particular age group. Based on all these factors, they will calculate the premium pricing. Claim, a formal request made by policyholder to receive the insured amount. Co-payment, percentage of claim amount paid by policyholder. So co-payment is usually seen in the corporate policy, corporate insurance policies, wherein they will be like 10 to 15% of the co-pay, and the rest amount would be paid by the insurance company. So we can take an example. If we fall ill and probably we are in an ICU, and that whole thing would cost around 1 lakh rupees, and if the policy have 10% copay, so we have to pay 10,000 rupees from our own, and 90,000 would be paid by the insurance company. Deductible and copay are almost similar. In copay, we have to pay based on the percentage. Deductible, we have a fixed amount, right? Percentage and the fixed amount, that is the difference. So deductible is a fixed amount you must pay first from your pocket before the insurance company starts paying. Why do insurance company use deductible? To prevent small claims, to reduce misuse of insurance. So let's consider an example. The hospital bill is 1 lakh rupees, deductible amount is 20,000 rupees. So instead of a percentage, there is a fixed amount. So we have to pay 20,000 and rest 80,000 would be paid by the insurance company. Surrender value. It is the amount the insurance company pays you if you decide to close the policy before its maturity date. We can take an example of an endowment plan, which is basically a term plan with savings, right? And let's suppose the endowment plan is for 30 years. And if you want to close that endowment plan after 6 years, then we will get the surrender value. We won't get the complete value, we'll get the surrender value, which would be the amount that we have given minus 30 to 40%, something like that. Lapse and revival of the policy. Lapse is basically policy becomes inactive. Revival is policy reactivated after paying dues plus interest. Annuity. Annuity is the fixed amount of money that we receive regularly, that would be monthly, quarterly, or yearly after retirement. So let's take an example. We have paid 50 lakh to an insurance company and we have bought an annuity plan, right? And from that plan, we'll get 30,000 per month for lifetime. So that regular payment of 30,000 rupees would be called an annuity.